I have previously talked about why it is often more tax advantageous for your heirs if you keep your home during your lifetime and they inherit the property only after you pass away. In essence, they get to skip out on a lot of taxes. However, forget the kids for a minute. What if you really wanted to downsize or just move somewhere nicer? Where's your tax benefit? Hi, I'm Andrew Bethel, and today I wanted to let you know about a huge tax savings you can receive on the sale of your home. As you're probably aware, when selling assets, we sometimes have to pay capital gains taxes on the difference between what we purchased the assets for and what we ultimately sold it for. But in California, you can exclude hundreds of thousands of dollars from that capital gain, meaning you can sell your home, make a nice profit, and not pay a cent in capital gains. And here's the kicker. Everything I'm about to tell you also applies federally, meaning that if you live in a state with the same or similar rules, such as California, then you could qualify for massive tax savings on the sale of your house automatically. Firstly, there are differences between individuals and married or registered domestic partners, so we'll tackle each of those groups separately. For individuals, you can exclude $250,000 of profit from the sale of your home, meaning capital gains only kick in on any gain over $250,000. If you follow what I call the 5222 rule, that is, during the 5 years before the sale, you own the property for at least 2 of the years, you occupied the home as a primary residence for at least 2 of the years, and you've not used this exclusion in the last 2 years. That's it. Next, we'll look at couples, because it only gets better from here. And when I say couples, just keep in mind, I mean both married couples and registered domestic partners. To start, since there are now 2 of you, that exclusion amount doubles to $500,000, meaning capital gains only on the gains over $500,000. Now you might be thinking, surely to qualify for such a large exclusion, there have to be more hoops to jump through, right? Well, not really. Firstly, the couple must have filed a joint return for the year of the sale, but aside from that, you're basically back with that 5222 rule again. In the 5 years leading up to the sale, either spouse has to meet that 2-year ownership requirement, both must meet the 2-year primary residency requirement, and neither has to have used this exclusion within the past 2 years. Keep in mind, everything I've discussed was about capital gains taxes, which are often different than your ordinary income tax rate. These exclusions apply federally, but you'll need to check with your individual state as to whether it allows this exclusion and what their capital gains tax rates are. For example, California's capital gains tax rate is in line with its normal income tax level, 1 to about 13%. New York's rate is 12.7%, Florida's is between 0 and 20, and Texas has no state capital gains tax. Regardless, this is a massive tax benefit and another tool for building generational wealth by allowing for more hard-earned assets and some of those gains to stay in the family. Estate planning is centered around building and maintaining generational wealth and how you really create a better life for your future generations. Thank you for watching. If you enjoyed the video, be sure to check out some of our other excellent videos here, but don't forget, hit the like button, subscribe, ring the bell, and tell us what you'd like for us to cover down in the comments below.